what point do we decide that Box, the cloud-based storage provider and mobile business collaboration platform, has been punished enough already? Here's a company that came public in January at $14, then spiked up to $23 on its first day of trading. But since then, it's basically been all downhill for the stock, which has pulled back to $13.21, including today's nearly 7% decline, even as the company reported better than expected revenues and gave robust guidance. After the conference call this morning, the sellers came in as part of a broader decline, although the stock managed to recover from its lows late in the day, unlike the entire market. Many of us were extremely positive about Box prospects after they saw these results, even though the company's not yet profitable. It's worth acknowledging that on a price-to-sales basis, Box has become darn cheap versus the other cloud plays that the company compares itself to. So should we view this weakness as a buying opportunity, or should we be more cautious given that the stock has been a total house of pain lately? Let's take a closer look with Aaron Levie. He's the co-founder, chairman, CEO of Box. Learn more about the quarter and where the company's headed. Mr. Levie, welcome back to Mad Money.
Hey, thanks, Jim. Appreciate the time.
All right, Aaron, do you find it kind of odd? This was a quarter, unlike some of the other quarters, where every analyst said congratulations, it's a great job. And yet in the end, stock goes down almost 7%. Is it time to just say, you know what, we're just going to keep doing what we're supposed to be doing and forget about the stock?
Well, I don't know that we're going to forget about the stock. We do definitely care about our shareholders. But, we are very focused on the long-term growth rate of the company, the long-term performance of the company, the competitiveness of our platform. And so we do have a very long-term view. We were going to let the stock do what it does, but I think we did put up some pretty strong numbers yesterday. 78.7 million in top-line revenue, nearly 90 million in top-line billings for the quarter, and then we raised guidance to about 300 million in revenue for this fiscal year. So we're very happy about the numbers. We think we're kicking off really kind of strong momentum going into next year, and we're going to let the stock respond as it does.
You have some close partners. I mean, it's not often that you have someone, as young a company as yours. You have Tim Cook at BoxWorks. You do a huge business with IBM. Partnerships, although maybe frenemies with Microsoft. How are these partnerships doing in terms of actually putting revenues into your bottom line?
Yeah, so the partnerships really kind of take on two different types of strategies for us. The first is technical interoperability and the ability to get access to your files and content from any application in any environment. So our partnership with Microsoft is incredibly important. If you're a customer of Office 365 and you want to be able to access your files from Box so you can edit them in real time within Office 365, we enable you to do that securely. And because of Satya Nadella, they have become a much more open company that we can work with, even though we do compete on the edge a little bit in some of their product lines. On the other hand, with IBM, this is a partnership that's both a channel sort of distribution opportunity for us, as well as additional technology that we are jointly building to really advance our solutions in enterprise content management. In the quarter, we actually signed a 6,000-seat deal at a customer called Sally Beauty Holdings. Right. That was because of the IBM partnership and the joint solutions that we're developing. And we have over 100 joint customers today in our pipeline, in our sales pipeline, because of that partnership. So we're going to do partnerships both for channel distribution as well as for really enhancing our technology and the interoperability of our product with other cloud solutions.
Well, given that these great opportunities, how do you balance the idea of the market saying maybe wanting you to be cash flow positive earlier, and yet at the same time that could constrain your growth?
Yeah, we spend a lot of time on this. Our executive team, our board of directors, what we have shared is our commitment to positive free cash flow by the end of next fiscal year. So that's the quarter ending January 2017. So we are very committed to getting to positive free cash flow. That said, we're not taking our foot off the gas in terms of investing in growth. We are very focused on this once-in-a-lifetime transition from on-premises data centers and on-premises computing to the cloud. You've seen this growth from Workday, from Salesforce.com, from ServiceNow, other major cloud products. And we want to do the same for enterprise content management and collaboration. So we see this as an important once-in-a-lifetime opportunity, and that's why we're making the investments that we are.
I'm glad you brought up Salesforce.com, because, we had Mark Benioff on recently, and there was a moment that was quite a little bit out of character for Mark. He stopped talking about how the great sales they had in the $8 billion, and just point blank attacked the unicorns. Said, I mean, come on, come public already. This is ridiculous. There was a terrific article called Crazy Like a Box in the New York Times. I'm sure you saw that. And here I am looking at Dropbox Dropbox Enterprises November 4th announcement that's meant to be a launching competitor with you. How has it been being public? Did it make sense to come public when you did? Do you wish you weren't public? And what are the advantages of being public?
Yeah, I actually think we're pretty happy about being public. I think this drives a level of cadence and rhythm in the business that we think is very healthy. It drives a certain degree of transparency that we also think is very important. If you're the CIO of General Electric or Eli Lilly or Toyota North America or Southwest Airlines, you want to ensure that you're working with technology partners where you know that they're going to be around for the long run. You understand that they're sustainable businesses. You have a sense of their financials, of the performance of the company, of the robustness of the company. And for us, being public dramatically accelerates those conversations, and it reduces the friction that maybe otherwise would exist if a large enterprise was working with a small startup. So we're very happy to be public. We're happy to be sort of a kind of post-unicorn company, as it were. I think it will be interesting from a Silicon Valley standpoint to watch over the next year or two what does happen to a lot of the private companies. Obviously, the valuations have gotten a bit aggressive over the past year. We're very fortunate that we have a tradable currency that that is measured on a regular basis. So we think it's a very different level of kind of transparency and kind of health in the business.
Well, I know that it's not your job to opine on competitors, but when Dropbox Enterprise comes out and basically says, listen, you love us at home, wait till you get to the corporation, and yet you're lined up with IBM, you have Apple, you have Microsoft. Isn't it too late? And this $10 billion last round, I mean, that was before you had all these partnerships yourself that really do box out Dropbox.
Well, yeah, I'm certainly not going to spend time justifying Dropbox's valuation, but what I would say is we spent the past 9 years building a very robust platform for the enterprise. So we started the company 10.5 years ago, and we pivoted the company into the enterprise market about 1.5 years into founding the business. So today we serve 55% of the Fortune 500. We have 54,000 businesses globally that use the product. You mentioned a bunch of the partners that we work with. So we do think that this is a land grab, and that this is the land grab that we've been investing in over the past few years. And fundamentally building a platform that secures critical corporate information and the various business processes that are around that corporate data is very different than building a consumer application aimed at the sort of consumer or personal market. We do think there's still a big opportunity for both companies, but we're 100% focused on the enterprise.
Well, I want to thank you so much for coming on. The analysts were very congratulatory. Aaron Levie, the co-founder, chairman, CEO of Box. Good to see you, sir. Thank you. These are young companies doing what's necessary to grow. You have to make up your own mind about what to do. This is not a 4% yielder that's growing at 3%. It's growing in the 30% and has a pretty bright future. Mad Money's back into the room. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.